Once upon a time, the phrase "made in China" was synonymous with low quality. Today, it defines the world's entire consumer economy. In the 1980s, the West discovered a loophole. By exporting production, they could import profits. China offered the perfect stage: cheap labor, lax regulations, and endless ambition. Factories sprouted like steel forests across the Pearl River Delta. As Western corporations realized that globalization was not about sharing prosperity but outsourcing responsibility. Between 1990 and 2010, over 400 million Chinese were lifted from poverty, the largest economic migration in human history. But the world's wealth was not distributed. It was The West applauded China's growth while quietly dismantling its own industries. Steel, textiles, electronics, all were shipped abroad in pursuit of margins and shareholder returns. In just 2 decades, China became the factory of the world. But beneath that success was an invisible cost: the erosion of domestic resilience and the rise of economic dependency. This was not an accident. It was strategy born from Deng Xiaoping's reforms, guided by state-backed industrial policies, and fueled by foreign capital desperate for cheap returns. China's leaders understood something the West forgot: control the means of production, and you eventually control the world's consumption. The cheap revolution was not only about goods, it was about power. The power to shape global inflation, labor markets, and even political decisions. But what happens when the foundation of the world economy, cheap labor and endless consumption, begins to fracture? When the world applauds China's rise, it often forgets the invisible cost: a hidden invoice paid in human sweat, polluted rivers, and poisoned skies. In the early 2000s, coal powered nearly 80% of China's electricity. Entire provinces became blackened by soot as factories ran day and night to meet global demand for cheap goods. From the smartphone in your pocket to the shirt on your back, each carries a hidden price tag of carbon, waste, and human fatigue. China's labor miracle was built on discipline, not democracy. Long hours, low pay, and minimal protections. The factory floor became both a ladder and a prison. In 2010, a wave of suicides at Foxconn factories shocked the world, a brutal reminder that the cost of global convenience was often human despair. Environmental devastation became systemic. Rivers turned toxic, farmlands became infertile, and smog levels reached dimensions visible from space. The Chinese government, aware of the damage, introduced the concept of the green GDP, a metric that attempted to calculate economic growth minus ecological destruction. But global consumers didn't want sustainability. They wanted affordability. Western brands pushed for even lower costs, and China responded by pushing harder. This was globalization's paradox: every dollar saved at checkout was a burden transferred onto distant workers and future generations. The illusion of prosperity became complete. The West outsourced pollution, labor, and responsibility and called it efficiency. By the 2010s, China wasn't just the factory of the world, it was the engine. Western economies had become deeply entangled in a web of Chinese-made components, materials, and logistics. Every car, smartphone, and airplane relied on a part made somewhere in China. From microchips to magnets, Beijing understood that dependence could become leverage. The 2008 financial crisis accelerated this dominance. While the West was drowning in debt, China flooded the global market with liquidity, cheap labor, and rapid stimulus. Western corporations had traded sovereignty for margins. They outsourced not just production, but innovation. Their factories became foreign, and so did their futures. The Belt and Road Initiative (BRI), launched in 2013, marked the next evolution. Not just manufacturing, but infrastructure. Ports and data cables now flowed through Beijing's orbit. From Pakistan to Kenya, highways and power grids were financed by Chinese loans and built by Chinese firms. The supply chain had become a geopolitical system. China learned from history. Empires once controlled seas with navies. Now, it was container ships and fiber optic cables. When the pandemic hit in 2020, the world discovered just how dependent it had become. From masks to medicine, everything flowed through Chinese ports. In those months, logistics became leverage. Nations that once lectured Beijing on economics now pleaded for medical supplies. By controlling the world's material backbone, China achieved what no empire had before: dominance not through conquest, but through dependency. In the global chessboard of power, the United States held the queen, the dollar. China, meanwhile, built the board itself: the factories, ports, and pipelines. Every year, China exported trillions of dollars worth of goods, and America paid for them in its own currency. The arrangement was elegant, but fragile. This gave the illusion of balance. America consumed, China produced, but underneath lay a deeper dependency. Both nations were now locked in a financial loop. China recycled its massive trade surpluses by buying U.S. Treasury bonds, effectively financing America's deficits. The creditor and the debtor were now partners in paradox. In the early 2000s, Beijing became Washington's banker. Every time America borrowed more, China's savings kept the system alive. This financial symbiosis became known as chimerica, a blend of capitalism and communism, consumerism and control. But this system also exported inflation, inequality, and instability. The West industrialized while China industrialized, both chasing short-term gains. As the dollar retained global dominance, China began asking why should the West dictate the price of everything, from oil to semiconductors. Slowly, Beijing began to challenge the dollar order, promoting the yuan for trade, building its own payment systems, and launching digital currency experiments. The new battleground was invisible, not tanks or trade wars, but control over code, currency, and confidence. The rise of China's low-cost economy sent shockwaves far beyond its borders. Entire industries in the West collapsed, replaced by imports that no one could compete with. Between 2000 and 2010, the US lost more than 5 million manufacturing jobs. Economists called it the China shock, but for millions of workers, it felt more like betrayal. In Europe, local industries from textiles to steel were hollowed out. Once bustling towns became monuments to the myth of globalization's promise. Cheap Chinese goods flooded African, Latin American, and Asian markets, undercutting local producers. Development became dependency, yet while others struggled, China's reach expanded. Infrastructure loans, construction projects, and trade agreements created a new form of global influence. In Latin America, soy, copper, and oil fueled China's factories. Economies that once looked to the US now found their future written in Mandarin contracts. Meanwhile, Western consumers enjoyed an illusion, a world where everything was cheaper, faster, and available at a click. But someone, somewhere, was paying the real cost. This race to the bottom became the defining economic model of the 21st century: growth without balance, progress without sustainability. The system couldn't last forever. Supply chains stretched too thin, prices became too distorted, and the global economy grew addicted to the illusion of infinite cheapness. In trying to make everything affordable, humanity made the future unaffordable. And when the cracks appeared, the world discovered that prosperity built on underpayment is prosperity built on sand. The era of cheap is ending. As the world wakes from its addiction to low cost and high consumption, we begin to see the bill for decades of economic illusion. China is no longer the cheap factory of the world. Wages have risen. Factories are moving to Vietnam and Bangladesh, and the Made in China label is losing its power as a global price anchor. But the world still depends on China for rare earth metals, solar panels, pharmaceutical precursors, and microchips. It's no longer just about cheap labor, it's about control over supply chains. The COVID-19 pandemic and the Ukraine war exposed how fragile global trade had become. A single factory shutdown in Shenzhen could paralyze an entire industry halfway across the world. Governments now speak of de-risking, nearshoring, and strategic autonomy. But rebuilding industries takes years, and few nations are ready to pay the true cost of independence. In the West, inflation rises as cheap imports fade. Consumers complain about prices, yet they forget, for decades we outsourced our stability to a foreign economy. Inside China, the model is cracking. Property crises, youth unemployment, and slowing exports show that even the world's manufacturing giant can run out of momentum. The Chinese government tries to pivot toward high-tech AI and green energy, but decades of dependency on exports cannot be undone overnight. The world stands at an inflection point. Either we learn from the illusion of cheapness or we repeat it with another nation, another crisis, another illusion. The cost of cheap was never measured in money alone. It was measured in trust, stability, and the future we sacrificed for a discount today. To survive, the world must relearn the value of what it pays for.